So we know the full impact of tariff uncertainty is not yet evident in the earnings season. Some say it'll take some time to work through. So how do you invest at this point? Joining me now is Noah Solomon, Chief Investment Officer at Outcome Metric Asset Management. He's here to talk about this and more. Thanks for joining us today.
Thank you for having me.
Let's get your take first on the Fed's decision to hold.
So the one thing that came out fast and ready and furious from Chairman Powell was you have heightened risks of two things. You have heightened risks of slowing growth and heightened risks of accelerating inflation. So he didn't say it, but he's basically saying you have heightened risks of what I call the S word, stagflation, which generally is not a good thing for asset prices or markets. I think that was the key takeaway, other than the fact that he said we're in a heightened period of uncertainty, and I don't know what I don't know what I don't know, most of it pertaining to tariff policy, which was mentioned several times.
Yeah, he was asked, I think at one point, why not take some preemptive action? And he said, as you mentioned, I don't have the data, so I don't know what the right response is if I don't have that data in front of me, and he just feels like he can't make a move yet, or the committee can't make a move yet.
That's right. The Fed is not a day trader. The Fed is a very considered position taker, and I don't think he has conviction one way or the other on either of the two mandates to take action at this time, especially given, as he stated, that he thinks monetary policy is currently appropriate.
Let's talk a little bit about some of the earnings we've seen. Uber and Disney coming out today. Disney was a surprise to me that they did as well as they have, considering American backlash. Uber was a bit of a disappointment, but has the earnings season overall so far shown resilience?
It has, but I don't take a tremendous amount. I mean, it means our starting point before, all this trade talk and trade tensions was a good one. That's what because earnings are what happened yesterday. And some of that yesterday did cover, what's gone on with respect to tariffs and U.S. trade policy. However, even that, I would put a grain of salt on the data for the simple reason that companies and consumers make purchase decisions, especially companies, well in advance. So a lot of the orders that show up in the earnings might have been placed before all the tariffs came into place and all the rhetoric that went out. The second thing I'd say is there's other gaming that goes on to the extent now that you think there are tariffs coming into a place, you're going to order a lot to get in sort of under the wire, which can make the data seem artificially good, and you get payback on the other end.
Let me talk about valuations as well, because you think that the valuations are too high, and so there's not protection against sort of the market up and down. Can you expand on that a little bit more?
Yeah, I wouldn't say I think valuations are too high per se, maybe with the exception of the S&P 500 where they are elevated. But other than that, they're sort of in the middle point of their range over the last 30 or 40 years. But to your point, the way I think of valuations is, depending on where valuations are, they can act as a buffer or some kind of insurance against an adverse event. So there's two things we know for sure about markets right now that sort of colors my view. The first thing is that, and this isn't news to any of the viewers, I'm sure, that we're in a tremendous amount of a period of uncertainty related to U.S. tariff policy. That's no secret. And the second thing is we're not really, I don't think that uncertainty is being reflected in asset prices or in valuations. So on the first point, I don't think I or anyone else can really have a lot of conviction on how these tariff policy in the U.S. plays out. And frankly, it could change every week for the next 24 weeks. So I'm going to put point one to bed. But point two is, in terms of valuations, I don't think there's a huge buffer right now. I don't think things are too richly valued, but they're certainly not cheap. So if I kind of think of valuation, if stocks were trading with a valuation of the high single digits, let's say, or low double digits, and something bad happened, or I was scared, I wouldn't be that scared because you have that buffer. It's being reflected in valuations. That's not the case today. I sort of like thinking of an adverse development as if getting punched in the face. If you're wearing a helmet and you get punched in the face, the damage will be limited. If you're not wearing a helmet,
you might go down.
you might go down. Markets, again, not richly valued, but they certainly don't have a helmet. I don't think the elevated risks are being reflected in valuations, which means you should probably be leaning defensive.
Okay, so given that, if you're leaning defensive, what kind of stocks are you looking at?
Well, when I say defensive, there's certain defensive in light of what's going on with tariffs.
Okay.
I would say there's a few attributes I would look at with respect to sectors and by extension stocks that would provide some kind of buffer against adverse developments, particularly as they relate to U.S. tariff policy. The first thing I would look for is not cyclically sensitive.
Okay.
So something like staples, utilities. The second thing I would look for is non-correlated to the general stocks. So I think gold stocks, regardless of whether you have a view on gold or not, tend not to be correlated with the broad index, so they offer diversification value when you need it. So I would say non-cyclical, number one, domestically focused in terms of your end demand, doesn't rely on imported goods for their final product. And if they do rely on their imported goods, they can pass that on. So grocery stores would be a good example. They're domestically focused, they're staples, they're non-volatile, and to the extent they have to import stuff from elsewhere, particularly the United States, they can, unfortunately for us, they can pass that through to their consumer. So those are the attributes. When I say defensive, those are the attributes I would look for.
With the idea that recession is kind of still the possibility here, not everybody's sort of putting it out there as much as they were maybe a month ago, would you pivot even further into some other defensive stocks, or are you keeping that strategy even facing down a recession?
A recession, well, I think they're all related to the extent that tariffs, the first order effect is they can affect your import costs, they can affect your demand. The second order effect is, to be very clear, tariffs are 100% sure, should they happen, are 100% to result in lower volumes and higher prices. That is one thing that is certain. Now, lower volumes result in lower corporate profit margins, which is counter-cyclical, in the sense that that's when companies put a pause on when their profit margins are under fire, they put a pause on expansion, they maybe shed workers, so the probability of a recession goes up. So you're defensive for the mechanics of tariffs, and then you're defensive to the extent that the second order effect is the probability of a recession goes up. So some things like utilities, you kind of get a double whammy of protection. Number one, because they are domestically focused. They're not exporting.
You need them.
You need them. They're a staple. And to the extent you do get a recession, interest rates will probably go down, which is good for utilities, which act as a bond proxy.
Got it. Okay. I do have to leave the conversation with you there. Noah Solomon is Chief Investment Officer at Outcome Metric Asset Management. Thanks for your time.
Thank you very much.
Coming up, we'll get you more on what's been driving markets today. We're back in a moment.